Welcome. Today we're diving into how partnerships are taxed in Malaysia under the Income Tax Act 1967. Unlike companies, a partnership isn't a separate taxable entity. Instead, the partnership's total income is calculated as if it were a single business. This calculation leads us to a crucial concept: provisional adjusted income. It's the business profit before dividing it among the partners. Throughout this video, we'll break down what provisional adjusted income means, how it's computed, and why it matters for both the partnership and each individual partner. Let's start by understanding the basics of this important tax concept. Provisional adjusted income is a key term in partnership taxation. It refers to the net profit or loss from the partnership business after making necessary tax adjustments, but before allocating partners' salaries, interest on capital, or drawings. Think of it as the partnership's income after all tax-related tweaks but before splitting the pie. It's called provisional because it's calculated for the partnership as a whole, not for individual partners yet. This figure forms the foundation for how much each partner will eventually report as their own business income. Simplify it even further. Provisional adjusted income is the business profit after making all necessary tax adjustments, adding back non-allowable expenses and deducting allowable ones, but before dividing the income among partners. It's the number you get before considering partners' salaries, interest on capital, or any drawings. This makes it the starting point for fair and transparent income allocation in a partnership. First step in computing provisional adjusted income is to take the accounting net profit or loss from the partnership's income statement. This is the profit figure before any tax-specific adjustments. It's the starting point for all further calculations, ensuring that the process is grounded in the actual financial performance of the partnership for the year. Next, you need to add back expenses that aren't deductible for tax purposes. These include partners' salaries and bonuses, interest on partners' capital or drawings, private or domestic expenses, income tax and penalties, depreciation and donations not approved by LHDN. These items are not allowed as deductions under Sections 33 and 39 of the ITA 1967, so they must be added back to the net profit. Let's look at some examples of non-allowable expenses. These typically include partners' salaries and bonuses, interest paid on partners' capital or drawings, private or domestic expenses, income tax and penalties, depreciation since it's replaced by capital allowances, and donations not approved by the tax authority. All these must be added back to the net profit to arrive at the correct taxable figure. Now deduct expenses that are wholly and exclusively incurred for producing gross income. These are allowable expenses and include staff salaries and wages, excluding partners, rent, utilities, insurance for business premises, repairs and maintenance, business-related travel, professional fees, and approved donations. Only these types of expenses can reduce the taxable income of the partnership. Allowable expenses are those directly tied to the business's operations. Examples include staff salaries and wages, excluding partners, rent, utilities, insurance for the business premises, repairs and maintenance, business-related travel expenses, professional fees, and donations that are approved by the tax authority. These deductions help ensure that only genuine business costs reduce the taxable income. In this step, you need to adjust for capital items. Add back any capital expenditure, such as the purchase of plant, machinery, or motor vehicles, because these are not deductible. Then deduct capital allowances as allowed under Schedule 3 of the ITA 1967. This ensures that only the appropriate portion of capital costs is recognized for tax purposes each year. After making all the necessary adjustments, adding back non-allowable expenses, deducting allowable expenses, and adjusting for capital items, you arrive at the provisional adjusted income. This is the adjusted business income of the partnership before any allocation to partners. It's the key figure used for further income division and tax reporting. See how this works in practice. Suppose ABC Partnership's income statement for 2024 shows a net profit of Rm 180,000. We add back partners' salaries Rm 40,000, depreciation Rm 10,000, and interest on partners' capital Rm 5,000. Then we deduct capital allowance Rm 8,000. The calculation is 180,000 plus 40,000 plus 10,000 plus 5,000 8,000 equals Rm 227,000. This Rm 227,000 is the provisional adjusted income for the partnership. Once the provisional adjusted income is determined, it's used to calculate the divisible income. This is the amount available for distribution to partners after deducting partners' salaries and interest on capital. Only then is each partner's share determined for tax purposes. This ensures that income is divided fairly and according to the partnership agreement. Relationship between provisional adjusted income and divisible income is straightforward. Provisional adjusted income is the partnership's total adjusted income before deducting partners' salaries or interest. Divisible income is what remains after those deductions. Each partner's share of the divisible income is then taxed individually in their personal tax return. Continuing our example, from the provisional adjusted income of Rm 227,000, we deduct partners' salaries, Rm 40,000, and interest on partners' capital, Rm 5,000. This leaves a divisible income of Rm 182,000. Partner A and B share profits equally. Each will report Rm 91,000 as business income in their individual tax returns. This process ensures transparency and fairness in income allocation. The partnership level, business income is computed collectively. Partners' salaries and interest on capital are added back and are not deductible for the partnership. However, these amounts are taxable to the individual partners who receive them. Drawings, on the other hand, are not deductible and are not taxable as they represent capital withdrawals. This distinction is crucial for accurate tax reporting. There are several key points to keep in mind. First, provisional adjusted income is the starting point for allocating income among partners. It's computed before considering partners' salaries or interest on capital. The partnership's adjusted income is distributed, not taxed, at the partnership level. Each partner is individually assessed on their share, ensuring fair and transparent allocation. Understanding provisional adjusted income is essential for both partners and accountants. It ensures that income is allocated fairly and transparently, following the partnership agreement. This process also guarantees that each partner pays the correct amount of tax on their share, avoiding disputes and ensuring compliance with tax laws. Here's a quick summary of the formula. Provisional adjusted income equals accounting profit plus non-allowable expenses minus non-taxable income and minus capital allowances. This formula helps ensure that all necessary adjustments are made before income is divided among partners. To wrap up, remember, provisional adjusted income is the adjusted profit before partners' appropriations. It represents the partnership's income as a business entity for the year and ensures accurate and fair distribution of income to partners. No tax is levied at the partnership level, only individual partners pay tax on their respective shares. Proper computation of provisional adjusted income is vital for compliance with Malaysian tax laws. It helps partnerships avoid penalties and ensures that each partner's tax return accurately reflects their share of the business income. Staying compliant not only avoids legal trouble but also builds trust among partners. In conclusion, provisional adjusted income is the cornerstone of partnership taxation in Malaysia. It ensures that income is fairly and transparently allocated among partners, with each partner paying tax only on their share. By following the correct steps and understanding the rules, partnerships can manage their tax obligations smoothly and confidently.